Welcome back, you legends. I'm Dr. Khan. Let's get right into this video. So the stock market was up 1.36% on the Nasdaq, the same on the S&P, and nearly the same on the Dow Jones. Let's take a look at the different sectors. Leading was energy, basic materials, and technology. Lagging were defensives and real estate. So just like that, we switched from being completely risk off a day ago to being completely risk on today, going into the FOMC minutes release, 2 p.m. Wednesday Eastern time. Let's take a look at the stock market map. Look at this. Green all over the place, specifically in tech, specifically in software names, as well as chip companies and energy. We don't typically see these sectors deep in the green like this unless risk appetite is back in the market and market participants are exposing themselves to more and more upside risk. Let's take a look at the daily chart for the S&P 500. Look at this beautiful green, full-bodied green candle. We held the 9-day moving average once, twice, 3 times. We continue to be squarely in an uptrend. The uptrend continues to be uninterrupted. PPO still moving up as the market grinds its way to the upside on declining volume, but this is typical of the Thanksgiving holiday week. We tend to see some of the lowest volumes in the stock market in the year. So far, so good. Let's take a look at the 2-hour chart. Something significant did happen yesterday. Look at this, folks. We were flagging for several days, forming this obvious, very clear bull pennant that broke out to the upside yesterday with a bullish crossover on the PPO on the 2-hour chart. Crossovers on the PPO on the 2-hour chart tend to happen at the beginning of reversals, either to the upside or to the downside, and we're seeing a bullish crossover, and that indicates a new short-term uptrend or a continuation of the short-term uptrend to the upside. Let's take a look at the Dow Jones. Look at this. The Dow Jones was flirting with a bearish crossover yesterday, but the market said, nope, we still want to keep moving to the upside. We want to grind our way up. And the Dow has now taken out all of these previous wicks, previous rejections, rejection. It has taken all of those out with a full-bodied green candle. This is very good news for the bulls. Let's take a look at the Nasdaq. The Nasdaq continues to underperform the S&P and the Dow Jones. Relatively speaking, we are still in this bull pennant flagging. This is just waiting for one piece of good news tomorrow just to completely rip to the upside. In a face-ripping rally, I expect a violent move that takes us all the way up to the upper edge of this Bollinger Band around $295 on the Nasdaq. That's a $9 move in a few days. Now, assuming the FOMC minutes do come out bullish or at least neutral, because the market does seem like it wants to keep grinding its way to the upside. So barring no negative surprises, we could see some pretty nice moves to the upside on the Nasdaq and tech and growth stocks in general. Let's take a look at another chart. This chart is a ratio chart that looks at the relative performance of the Nasdaq relative to the S&P 500, and something significant happened yesterday. Look at this. We gapped up and we ran right after the CPI release. We retested that same level again. It held. That's very good news for the bulls, and we're now moving back up to the upside. So again, the market is just waiting. It's been waiting for a week and a half now, just grinding its way sideways, waiting for this FOMC minutes release at 2 p.m. Wednesday to make up its mind. And so far, we're still in a bullish uptrend, everybody. Look at this. A low, higher low, another higher low, boom high, a higher high, another higher high. We're still squarely in an uptrend. The PPO is still moving up. Nothing on this chart says to me to go short. Nothing at all. So again, barring any nasty surprises, the market should see some pretty nice moves to the upside that goes hand in hand with historical seasonality for the late November, early December timeframe, where we see violent rallies to the upside. Let's take a look at another chart. This is the smart money up top, the dumb money down below. The HYG has actually taken out this prior high. Right over here, we actually had this significant negative divergence where the S&P took out the prior high. The HYG actually failed to do that, and a lot of people were looking at that, expecting the market to turn and move to the downside. I actually disagreed, and I talked about this in the trading community. I do not tend to like to use medium-term divergences to predict short-term market direction, because these medium-term divergences can end up dying out. We had the exact same thing happen back here. Let's take a look. Look at this. We made a high on the smart money. We made a slightly lower high several weeks later. The S&P took out this prior high. This was a nasty negative divergence, or so many people thought. I disagreed, and look at that. Just a few days later, we took out that divergence with a forceful move to the upside. I suspect the same may be happening pretty soon. The divergences that I like to track are short-term divergences, where the S&P makes successive lower lows as the smart money makes successive higher lows. That's a bullish divergence, and in nearly all cases it ends up breaking to the upside. I also track other short-term divergences where the S&P makes successive higher highs in tops and the HYG makes successive lower highs. These also nearly always break to the downside and change the stock market trend. In summary, guys, the market has actually been chopping about for several days now. This is the S&P. Look at this massive chop fest that we had. If you actually went long here using options, you will most likely have lost a lot of money simply due to time decay on those options contracts. If you were a bear and you went short here, you would have also lost money on your puts, again because of time decay. And that's why picking tops and bottoms is so hard. In fact, most money managers will tell you it's impossible. I completely disagree with that. My entire trading career is actually based on picking bottoms and tops. And so far this year, we've been 100% right in picking every single bottom and every single top. Just check the YouTube video history and you'll see every single time we've done it. So knock on wood, this continues. And I'm bringing this up, everybody, because a lot of people have actually been calling the top here, and I disagreed simply because the indicators did not support that thesis. None of my indicators showed a sell signal at this level here. We still have an obvious air pocket here before we hit the upside resistance, a line that we tagged several times this past year. Look at this systematically. We've been tagging this resistance line. We still have some upside left in this move. We could come short of tagging this resistance line. We could even overshoot it. We don't know yet, but what we know is that there are no sell signals at this moment. This could change in a day. This market is extremely unpredictable, but setting emotions aside, we have to follow our charts and our technical indicators. And so far they're saying continue to be long, but cautiously. Let's take a look at another chart, everybody. Let's take a look at the VIX. The VIX continues to fall off a cliff, even though the stock market has actually been moving sideways. Let's add the S&P 500 on here so you guys can see what I'm talking about. Look at this. This has been a chop fest. Now, it looks more like a bull flag. The VIX was declining throughout this period of choppiness, and the declining VIX at the top, or what seemed to be the top of a move, usually indicates more upside is coming, because the VIX usually begins to move sideways, chop around for several days when the market actually tops. It does not tend to move to the downside, pricing volatility out of the market. This happened systematically throughout this year. Check out my previous videos if you're interested. This VIX sell signal has been year to date 100% accurate. It has not been triggered just yet, and I don't see any signs of this signal being triggered in the short term. The VIX continues to show more upside potential for the S&P 500. Let's take a look at another critical ratio chart. This is XLY, consumer discretionary, divided by XLP, consumer staples. This is a risk on versus risk off indicator that looks at the most aggressive, most risky part of the stock market, which is consumer discretionaries, divided by the safest, the most defensive part of the stock market, consumer staples. And we're seeing a double bottom in this ratio. I talked about this in the last video. We had the exact same setup back here. Look at this, and the market ended up rallying to the upside. This double bottom hasn't been confirmed just yet. I need to see a big green candle on this ratio chart to confirm that this is indeed a double bottom. And if the market does end up rallying after the FOMC minutes come out, this ratio chart will likely confirm a double bottom. I talked about this in the trading community. This is the trading community, everybody. I'm at UTC +3, so 6 p.m. for me is around 11 a.m. Eastern time. Good sign, everybody. A green candle is forming. I need to see a big green candle today on this ratio chart. I was talking about the XLY divided by XLP ratio chart. Another critical development was this. This is the Nasdaq relative to the S&P 500. We're holding at the exact spot following the CPI release, which is excellent news. Boom, we tagged the exact same level following the CPI release, and we bounced back up, indicating that yes, the uptrend is still intact as of this moment. I also talked about a specific development in Tesla, and in fact, we are in a Tesla trade that if it does end up going our way, we will make over 1,000% before the end of the year. I detail this trade. We're also in another long trade in another name. You can track every single trade and investment that I make in real time in the trading community. I post every single trade that I make in my trades right over here. I also post daily intra-market, pre-market, and post-market analysis right here in the live analysis channel. Timely and actionable market analysis that shapes how we look at the market and how we enter and exit the market. I'm also building a library of every single chart that you see in the videos right here in my charts. That includes the S&P 500, the Nasdaq, my Dow theory model, my smart money and dumb money sell and buy signals, my CPC put to call ratio buy and sell signal, my VIX chart, my VIX sell signal, pretty much all of my secret weapons right here in my charts. You can click on any of my charts and you will be taken to a live version of that chart where you can see the signals, my annotations, price targets, and so on and so forth. Again, all of that as well as all of my trade ideas go in this trading community. Check it out in the link in the description below if you're interested. We have a 50% off Black Friday sale for the annual membership that comes out to $25 per month if you go for the annual membership, and you get access to all of these goodies. It's also the best way to support me if that's something you want to do, and it's the best way to keep track of all of my work in the fastest and most efficient way, including on days where I am not able to upload a YouTube video. We have over 1,400 active members, and I'm so incredibly proud of this community. This is bar none the best trading community. And if you've seen some of my previous videos, you will know that this is absolutely true based on some of the absolutely historical trades that some of our members have taken, including a 10,000% gain in a single day when we called the bottom back here on October 13th. One of our members made over 10,000% in a single day. Absolutely life-changing money. So check it out if you're interested, and thank you so much, everybody. Now let's take a look at another chart. This is XLK divided by SPY. This is the S&P 500 tech sector divided by the S&P 500, and look at this, boom, boom. We're now flagging. We have held the 20-day moving average as this ratio has been moving sideways for several months now, and it looks primed to move back to the upside because we've taken back this 50-day moving average. The market dipped below it once and then it completely reversed the second day, saying, nope, we want to keep moving to the upside. Let's take a look at another chart. This is DXY, the dollar index. The dollar index continues to flag. This looks to me like a bear flag, just waiting to break to the downside on any positive news for the stock market, including a more dovish Fed. And we'll know for sure after the FOMC minutes come out. Let's take a look at another chart. The 10-year yield continues to collapse. We called the top on the 10-year yield. Boom, right here. And in fact, we predicted this exact breakdown in the 10-year yield to the day on November 10th, just before the CPI inflation data came out. We have now broken down below the 20-day and the 50-day, and we failed to reclaim it. This is very bullish for the stock market. A decline in yields means valuations for the entire stock market move up, translating to the everything rally where everything in the stock market moves to the upside. Let's take a look at another chart. This is the golden chart that allowed us to capture this entire move to the upside. Up top is the percent of S&P 500 stocks above their 200-day moving average, and we tracked this monstrous divergence that we talked about for weeks and weeks. Nobody else seemed to notice this divergence. We saw the exact same setup back in 2016, and the market ended up rallying massively, 15% in 45 trading days. So far, we've had the exact same rally, about 15% in about half the time, and we still have more upside left. So if you've been following this channel and you did catch this bottom and move to the upside, you will have made over 15% just in the last month. That's 2x the annual return, the average annual return of the stock market in a single month. And if you've leveraged that using options, using futures or anything else, you could have easily doubled, tripled, even quadrupled your money. Let's take a look at another chart. This is the NYSE Composite Index up top, and down below is the Summation Index, the McClellan Volume Summation Index. We're still squarely in an uptrend. I was looking for a bearish cross over, a cross down. This happens near tops or at tops, or usually right after the market tops. We haven't seen that yet. The market still wants to keep moving to the upside, perhaps making one final push to the upside, one final divergence before topping. Again, this is why I don't like to use the Summation Index as a market timing tool, because we tend to see these significant divergences develop over weeks and weeks and weeks before the market even tops. And that's why I prefer the smart money divergence as well as the VIX sell signal, because they usually mark the top on the exact day. Let's take a look at the Fear and Greed Index. We're sitting at 62. We've now taken back the 125-day moving average. We flagged above it, and we appear to be ready to move back to the upside, again, barring no nasty surprises. Stock price strength is slowing down near a prior level of resistance. Now, if the market rallies again, we will see this shoot up to the upside even more. Stock price breadth continues to move to the upside. I showed you this chart right here. Look at that. We even took out the prior high in August, and we haven't even made a new high on the S&P 500 versus August. And we're seeing more and more stocks in the S&P 500 participating in this rally. Put to call ratio moving slightly up to the upside today, leading into the FOMC minutes. So we're seeing some hedging taking place. In fact, I talked about hedging very efficiently, using only 2% of your capital to protect your entire portfolio going into the FOMC minutes. Again, all the details will be in the trading community. Market volatility continues to move down. Safe haven demand slightly a slight uptick to the upside heading into the FOMC minutes, so some nervousness in the market. Junk bond demand slightly slowing down again, heading into this risky event on Wednesday. Let's take a look at the economic calendar, and this is what everybody's been afraid of. The jobless claims coming out, as well as, boom, the FOMC minutes at 2 p.m. Following the FOMC minutes, we don't really have many important economic events until November the 30th, when we'll have the job openings for October. Between then and the 13th of December, it's not even on here, but I have it, I track it, we'll have the next FOMC meeting, the next rate hike decision, and before that we'll have another PPI reading and another PCE inflation reading, and unemployment. So a lot of risky events coming up early December that could steer the market either to the upside even more or to the downside, ending this nice uptrend that we've seen so far since mid-October. Again, check out the link in the description to join, to take advantage of that 50% off Black Friday sale. It ends on Friday. And that's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.